Literally the computer says, okay, here's all these people who owe us money, or here's all these people who have income that doesn't match the tax return. And those get printed and then someone stuffs them and someone mails them. But Don't ever go in hot-headed thinking that you're just going to, oh, they can go through all of my receipts. They will not. And you will lose all credibility with the auditor.
Hey, Jessica, I'm so happy to have you back. And we're going to talk about another topic right now. I'm excited.
I'm excited too.
So this is one I know you're going to save. Those of you listening, you're going to save it. We're going to talk about audits. We're going to talk about how to avoid them, how to navigate them, and how they happen. So Jessica has some great information for us. And if you did not listen to her part one, definitely go back and listen to that. You'll hear all about Jessica. We're going to dive right in on part two and ask you about IRS audits. We were just chatting about this before we hit record, and I wanted to hit record again and record another episode because this is gold. So Jessica, how like IRS audits, right? Why do they happen, and why do they happen to certain people?
So the interesting thing about audits is there's several different ways that people get, I say, caught, right? So avoiding an audit, the best way to avoid the audit is report all your income, don't overstate your expenses. But most people get caught usually for not the reason why they think. So if someone, didn't take a salary when they were required, that may not be the reason why the audit is triggered. Usually they're caught for something else. They're usually caught because all of the income reported on the tax return does not match third-party reported records. Those include W-2s, 1099s, and K-1s, stuff like that. And then typically that is the number one reason that people are going to get kind of flagged. And then once that return is pulled in for review, that is when other items are usually opened. So typically you're going to have maybe your meals, your travel, car and truck. Those are usually the most common ones. Obviously with more complex tax concerns, there can be other items that are open, but those are typically what I see more often of. And really some of the other ways that people are audited are just kind of based off comparables. So, the IRS might look at, let's say 100, CPAs in your area, and they will compare these returns and they'll say, okay, so we're looking at gross income, we're looking at salary, we're looking at marketing. We're trying to see where does something stand out. So I had a client who happens to be a real estate agent, and for all intents and purposes, everything was fine on his return. He didn't underreport, and he didn't take too aggressive of a position on any of his expenses. The problem was his marketing budget was more than 50% of his gross receipts, which is not unusual, but in his comparison, that stood out. So there are just sometimes things that happen, and you can't always prevent the audit, but it's more important to prepare for the audit and have all of your ducks in a row than it is to try to prevent it.
I totally agree. And my understanding is that the comparables are really derived a lot from the NAICS code that's on your return. Is that true?
Yes, it is. Especially when they're comparing specific industries. Now, there are some of these codes that have not caught up with modern day jobs. There's really no code for influencer, right? There's no code for even some of the technical jobs, that you're going to find. So some people are choosing this other category, which I've heard some people say that they choose this other category, that 99999, because it's kind of like a catch-all. Everybody throws everything in there and they can't get a real good comparison on that. But then that also just throws more people into this other category. And now you just have comparables that are so crazy. And maybe someone who normally wouldn't stand out, unfortunately now does. And so they get pulled for audit. But yeah, usually it's those codes that are going to at least identify the industry for which they're going to compare to. So yes, if you have a code that isn't proper for your business, they could be comparing you to businesses that are really not mirrored with the same kind of service offering or product that you sell.
And for those wondering, the NAICS code is a 6-digit code at the top of your tax return. It's on your Schedule C, or it could be on your 1120S. And these are all just the form names, but they're on the top of your tax return for your business. And what it does is it declares the industry of your business. And what a lot of people don't realize is that it's really important to get that right, because some people will start a business under one NAICS code and then decide to pivot their business, but not change, not start a new business with a new
Mm-hmm.
code, but now you're in a comparable pool with everything in your old industry, and what that could make you stand out. So we always advise our clients like, well, what's the NAICS code for this? And how have you been reporting it? Because that's how the IRS will see you. They'll assume you are a construction company. But if you'd stopped doing that and you went into, I don't know, you started
Farming.
selling things on Etsy, right? Then that's like, well, that makes no sense why you have all these expenses. So that's one way to trigger. This is what I always say. My advice, and tell me if you agree, is the number one way that you trigger an audit is when your story doesn't line up.
Yes. When your story doesn't line up, that's a good way to put it. Because I have, in my experience, and I've represented a variety of matters. I think it's around 2,000 that are a combination between like past due taxes and audits and whatnot. And, really the comparables are usually where most people get caught. And if you are being compared to an industry completely unrelated, it's unfortunately going to probably put you in the bad running.
Yeah. And a lot of folks really dread the whole audit thing. And actually shifting gears for a second, we're really in a time right now, we're recording this in 2022, where the IRS is kind of quiet. Why? Because they're understaffed. They're behind, really, really freaking behind. And your guys are getting letters right now. My clients are getting letters right now about 2018, 2019 returns. So that tells you how behind they are. And, what is your projection, Jessica, for, at some point, they're going to be looking at 2021, 2020 tax returns when, let's be honest, it was kind of a CF, especially during COVID, especially when accountants were trying to like piece it together, go digital. The whole profession was turned upside down. And now, and tax laws were changing mid-tax season. It was a mess for us as practitioners, but also, for our clients, they could be concerned that, okay, I took did I treat my PPP correctly? Did I do this correctly? And it's out of sight, out of mind now, but what might people experience when they do get caught up? What could happen, or what should they be looking out for?
So there's a couple ways that, or a couple time periods that the IRS has to what they call assess the additional taxes. So audits typically occur within a 3-year time period. So 2018 is now what's considered out of statute. So in many cases, the IRS will not likely assess a tax based on an underreporting or an audit of some sort for 2018. But that means we have 2019, 2020, and 2021. So 3 years from the time of the original due date of the return, or a timely filed return with an extension. So 3 years to assess the tax. So, and there's no statute for fraud. So you might think that you skirted, the 2018 statute or 17 or 16. If at any point in time, the IRS believes that there is fraud involved, they have an unlimited statute. And so it's very common that you go into an audit for 1 year and they'll go back 3. They can go forward 1. Maybe, if you're planning to file, they might want to look at that before you file. But they can go back. I've seen audits open for 5 years. And mind you, 5 years is after the statute. And this applies to timely filed returns. If you don't file the return, the statute doesn't start, the clock doesn't start until that return is filed. So they'll go back a number of years if necessary, if they believe that there is fraud involved. So I know that a lot right now, there are a ton of tax practitioners out there that are erring on the side of, well, the IRS is so busy, they'll never catch me. And maybe that is putting them in a position where they're open to having more aggressive tax positions for their taxpayers. And the unfortunate part is the taxpayer is the one that holds the bag, because the taxpayer signed under penalty of perjury that what they provided to the IRS is correct. So if you are working with a tax professional that is, maybe teetering on the aggressive side or just not concerned, most tax practitioners that adopt legal tax strategies or adopt legal positions, they do so by citing the code. And the code is definitely open to interpretation. But I know if my client says, I'm not sure this expense makes sense, why is this here? Ideally, I'm going to cite a authoritative source. So authoritative includes tax court decisions and certain parts of the code. There's publications really aren't the most authoritative, but there are like decisions and memos that are made that are considered authoritative. And if that person is taking a position based off one of those measures, then, typically they have an argument to stand for you. But if they're just saying, well, that's just what I believe is the reason for why this applies, then you might find yourself in hot water if the IRS catches you. And they are going to catch up. I mean, I know they're understaffed and overwhelmed now, but the IRS collects the money for our country to run. So at some point, they're going to need to stop the bleeding and get back to business as usual.
Yeah. And they will have to catch up. It's my opinion. Also, I'm being selfish because this is the primary years where I prepared a lot of tax returns, but I wish they would just take 2020 to 2021 and say, you know what? It is what it is.
Get everyone a pass, right?
Right. Like call it is what it is. Honestly, because they're so behind and how much time that we've wasted in responding to letters that were totally incorrect. And here's another thing that we did not touch on last episode. I cannot believe how many IRS letters are incorrect. Like they cannot do math. And what I remind clients of all the time, tell me if you agree with this, because I say it all the time to try to dispel with clients is, you got some intern that sent the blank email. You know what I'm talking about? Like that intern that sent the email to like the whole company, the whole customer base.
They accidentally hit reply all.
Yeah, they hit reply all to the whole world. And that person is like, who's sitting at the IRS right now. They got fired and they went to go work there. So remember that these are people who like work at the DMV. And by the way, like no shame if you do, but like, there's a certain type of person and certain type of patience you have to have with these people that like, they're not getting paid a ton. These are people who the IRS will literally hire anyone with a heartbeat because they're so desperate for help. They will. And there are plenty of great qualified people who work there, but there's also, you have to have the right expectations of what you're reading. And someone plugged that into a formula, spit out a letter. Like you guys put so much weight on these letters. And I'm telling you that most of us as practitioners, Jessica included, because I see her smiling, is like, don't take it too seriously. Like it's probably some intern filled this out, right? Like, is that kind of how you look at it?
Well, here's kind of the crazy part. So most of the letters that you're going to receive, and I don't recall all of the letter types, but I know like a CP 2000, which is like an underreporting, that's computer generated. Yep. So most of these letters are not being compared to actual records. So when I say they're computer generated, literally the computer says, okay, here's all these people who owe us money, or here's all these people who have income that doesn't match the tax return. And those get printed and then someone stuffs them and someone mails them. Right. And the unfortunate thing, because the IRS is so desperate, the time for training people has significantly been reduced. My understanding is at one point it was training of 6 months before an agent was allowed on the phone. I believe that's been reduced to 6. And then also, the other thing with how the IRS is working, their phones are so overloaded. I mean, if somebody doesn't know the answer, they'll just hang up on you. Yeah. And as practitioners, I mean, Jen, I don't know exactly how long you've been in the industry. I know it's been probably similar to how long I've been in. I've been doing this for about 12 years. There are no tax experts in all areas. I mean, you and I were discussing recently, like who are my, my top 10 for who I know will always give the right answer. Yeah. But even still, those people have to research and form their opinions based off their research. So when you think of putting someone on the phone who's supposed to answer taxpayer questions, who's maybe had 6 weeks of training, it's impossible for these people to know the answers to everything. And so honestly, calling the IRS and expecting the agent that the answer that the agent is going to give you to be the end all to the answer is not the best idea. I can count on one hand how many times I've had revenue agents consistently know even the process for adopting or approaching a matter to resolve it.
So, I mean, you're saying that the person who's like, you hear their dog in the background, they're working from home, that person isn't the authority on tax law?
Hate to break it to you, but I can't tell you how many times I've had clients or even other tax practitioners, a lot of the newer practitioners usually fall for this trap. Well, the IRS agent told me this. I'm like, do you realize the lack of education that some of these agents have? Different phone lines have different level of experience. So if you are calling the practitioner line for like the individual side of things, those people are typically less experienced than maybe the people who are on the business line. And then same thing goes for the phone lines available for the public. Those people are even less experienced. typically because the public doesn't have the most complex of questions, but they are also less experienced to account for all the little, minor changes that can affect an entire tax situation. I mean, the difference between someone being considered legally separated versus divorced versus, single and with a dependent. I mean, just one little thing changes the whole end result.
Right. And these folks too, like I've talked to them, they're delightful, but you also you don't use them as authoritative guidance. And but unfortunately, a lot of taxpayers, a lot of you listening, you might call the IRS and say, well, the IRS told me, well, it doesn't stand up though, which is crazy, right? Like in theory, that's crazy. Cause you think about calling a company, thinking about calling like Comcast. Like I used to do this all the time. Like, well, this person told me that I could get this price. And they're like, I don't know where they got that from. And it's so frustrating because you call the same company and you're like, why don't you have one like clear answer to my question? And the IRS is no different. And trust me, we are just as frustrated as you about that because I called the IRS countless times. And sometimes guys, when I call the IRS, this is why I charge for correspondence, by the way, for anyone who's asked me about this, is because I will call them and I will call them multiple times to see if I get the same answer. Because if I get the same answer from 2 or 3 different people, I'll know, okay, that's probably the right answer. But if I get conflicting answers, then I have to go deeper. So it's kind of a sample test in a way, and it's worth doing because it's so inconsistent. And Jessica's absolutely right. So would you recommend, here's the thing, would you recommend if someone has a question that it's relatively simple, that they do call the IRS, or do you recommend they go a different route?
Gosh, with the state of how the phone lines are right now, I have to say you could probably get a better answer going to like a tax professional forum if they'll allow you in there and asking a group of professionals, even though we also know in the professional environment, many people might have different answers, but you could get someone who will point you to the source for supporting their decision. But sometimes, again, depending on the question, the IRS website is actually very informative. Simple questions to many expenses can be answered from, let's say, a publication. Although they are not authoritative, they are still good starting points. And if for some reason your research leads you on, going down the rabbit hole, reach out to a couple tax professionals, pay for their consultation. They can go over, again, citing their sources, providing you any legal research or legal opinions. But right now it's just so difficult. The IRS is getting tons of calls because refunds haven't been processed. Calling the IRS in many cases will not change that for you. So the unfortunate thing is they just have more calls that they should not be taking. And they know it's their fault. They don't have modern technology. People are surprised when I tell them you cannot email the IRS. They operate off fax machine, and that is not a joke. They still operate fax machine.
Fax machine.
I only need a fax for them.
And if you guys picture the movie Office Space, and what's so funny, we have a whole generation of people listening to this who don't even know that movie. That's how old it is. And like you picture Office Space, you picture the fax machines. These guys are in 1992 or earlier. And when it comes to technology, they're picking up the physical landline phones. I can picture it. I've seen pictures of the Utah, the location there, and the files and the papers
stacked up.
And it gives me anxiety as a millennial to look at that and go, oh my God, like my clients' papers are in that. Like what a mess. And there's nothing we can do about it, and here's the other thing. Don't call your tax pro asking where your refund is either. Now, we have our practitioner line, but we are just as much in the dark and just as unable to get in touch with these folks as you guys are. The best thing to do is use the online tool, Where's My Refund? At least they have that now, but it will only give you so much of a glimpse into where your stuff is. So I wanted to switch gears and jump back to audits real quick, Jessica. And I wanted to ask you, because a lot of the folks listening have never been through an audit, which is great. But how long do audits last? Like what is involved? And are there different types of audits? Like, are they always going to come to your house with a briefcase and ask you a bunch of questions? Like, what does this actually look like in 2022? Like what actually happens if someone gets picked for audit, just in case they get a letter and they're like, oh my God, my life is over. Tell them what actually is going to happen.
So there are a handful of different audit types. So the most common is simply a underreporting, letter. And the letter typically says, you reported $100,000 of gross income, but our records show you should have had 150,000. And they will assess what they believe the tax will be. They will send you a letter. This is what we think you owe. Argue with us.
Yep.
And if you don't reply to that, then what happens is it becomes an assessment. And once it's assessed, then you do have some channels potentially to correct it, but it's harder at that point because you're working with two different agencies, parts of the IRS. You have collections, which their only job is to collect money. And then you have, audits and appeals and all that kind of stuff. So don't ignore the letter if you get a notice, if it says, oh, we believe that the information you provided is wrong. Answer it and try to answer it before it becomes final. The other one is considered correspondence audit. They're going to send you typically what's called a notice of deficiency. The notice of deficiency will lay out all of the adjustments to your tax return. And typically that means that they're disallowing usually all of your expenses for a particular category. And they say, prove to us that these were real. So that typically requires, compiling your receipts, compiling your books and records. This is why this is so important. During my training, my attorney mentor told me, if you typically can provide the bookkeeping supporting details, so like, you've got your expense for 5,000, you've got the supporting detail that has all of those numbers. If you can provide the supporting detail to at least match what you reported on the return, then the IRS is less likely to consider it to be a fraudulent approach to that expense. So you may not have all the receipts, but you at least have the supporting documentation to prove why you came up with that number. Also, it's super important to not just keep bank statements or credit card statements. Those are not enough in an audit. Receipts are always required. So if you pay something on a credit card, the IRS will want the credit card statement. They will want the receipt for the item that you purchased, and they'll want the bank statement in some capacity to pay the credit balance. And they'll see what your payment history is to see if it's something that you should really be taking.
Now, here's a question. Amazon, like the receipts. When you say a receipt, like it's 2022, what constitutes a receipt that's good enough?
So a receipt is going to be anything that will have an itemized breakdown of what you've purchased. So many of you may have heard this. You cannot just take a expense category or let's say if you buy something from Target. Saying that you bought office supplies at Target is not going to fly because Target sells more than office supplies.
Right.
So your receipt is what's going to really break down and say, okay, were these truly office related? Or did you also maybe buy some makeup or clothing and try to pass it as office supplies?
Right.
So that's why receipts are so important. Same thing with Amazon. You will never just be able to say, oh, here's my purchase from Amazon. You're going to have to provide the whole breakdown to show what was included in those within those purchases. So it's super important to have a proper itemized breakdown of what you purchased.
I love
and
that.
You don't need physical copies either. Electronic are fine. You do, in some cases, have to provide a photocopy of the receipt, but original receipts are not required. And I also recommend not maintaining original receipts because they fade. And if they fade and cannot be read, you're not going to get that deduction if that comes into question. So scan them, put them in a drive. Hopefully you don't have to look at them unless an audit comes up. But after, that kind of correspondence audit, there's also an in-person audit. And typically the process is still similar. You have that notice of deficiency, and the notice of deficiency, guys, is extremely important. There is a deadline on that date on that letter that will allow you to preserve your rights before the tax court. So if for some reason you're unable to resolve the terms of the audit at the audit level, you do have the opportunity to preserve your rights and go through the channels of tax court. It requires an attorney or a tax court practitioner to prepare the petition to preserve your rights in tax court. And in many cases, you might get to appeals and you might settle prior to that. But it's super important that you do that because it just preserves your rights to address parts of that audit. But yeah, typically that'll be, I approach them all the same. I print all the information. If I'm going to a in-person audit or if I'm mailing it, I put my fancy little flags on there. I put it in nice, perfect order because the IRS loves that. The worst thing you can do is walk into their office with a box of receipts and say, you deal with this. Because every person that I've ever represented who did that got hammered by the IRS because they don't have the time to do it. They will just say, I'm not doing that. I'm going to disallow it if you don't do this. So be nice to these people, make everything nice and clean and put together. In-person audits are sometimes fun because you get to kind of, get a little chatty, say, oh yeah, let's look at this. And they might say, I wanted to look at, this purchase on this date. You can go just to that, right? And you can show them that one receipt. And if they do that enough, 3 or 4 times and it's consistent, then they might not look through the whole thing. And I've had that happen. And even though there were maybe some things that might have been on the questionable side, I've been able to have, no change audits occur simply because all the other documentation was put together. So the presentation matters. But don't ever go in hot-headed thinking that you're just going to, they can go through all of my receipts. They will not. And you will lose all credibility with the auditor.
And by the way, guys, a no change audit means you win. Means that they got nothing. They got nothing to change, which is really that's a good accomplishment because they will want to find something. So a former revenue agent that I worked with as a mentor, he told me, and I think this is so true, that their goal, if you were to really put it, it sounds cold-hearted, but their goal is to go in, get as much as they can and get out. So they want to go in and find whatever it is they're looking for. If there's a reason to look for it, they want to go in and be able to recover any underreported income or whatever it may be and get out. The first thing they normally do, from my experience, is look through the bank statements and make sure all deposits were recorded as income on the business bank account. So that's another reason. Again, guys, keep your business and personal separated. You do not want to hand over a set of personal bank statements with your whole life financially exposed, and them having them think that, grandma's birthday gift is going to be business income because it was a deposit. And it's just that they can't tell the difference. I was an auditor for years, not for the IRS, but I have an auditor mindset. And one of the best ways that you can navigate these things, honestly, is to build trust. Building trust. And that doesn't mean be sleazy. That doesn't mean suck up. That doesn't mean be like, we can see through it. Like an auditor can see through when you're trying to be nice. But the one way to build trust is exactly what Jessica said. It's to just demonstrate behavior that's trustworthy, meaning if you recorded all your PayPal income, you recorded all your cash deposits, you reported all of your 1099s, you reported everything. And then you could substantiate those nitpicky expenses they picked. After a certain point in time, they go, okay, she could have not claimed the cash. She could things that are very easy and tempting for you to cheat and shortcut. If you don't, and you do it right, I feel like that gets you, it goes a long way. Would you agree?
It absolutely does. It absolutely does. And I will say, probably the most fun part about auditing for me was hearing what the taxpayer thought was a really clever idea, that it was super original and no one has ever thought about that before. And that's why they took this position or had this particular tax structure. They have seen everything. And it's so funny to me when somebody holds tight to, well, no, this is an original idea. I came up with this and I know this is going to, pass the sniff test. And then you're like, here's this publication that says that's an abusive, tax shelter. Here's this that says you can't legally operate, that type of business out of this type of entity type. So you're not the first one to think about it. And another big audit red flag, and I'm only saying this because we have now this culture where we are digital nomads and we travel all over the US. Don't put your RV on your tax return. That has been disallowed in almost every instance because it's almost impossible to have an RV that doesn't have some personal mixed use. So if you're trying to use that as an office space and you're trying to get deductions for that, it will absolutely be thrown out. And I've seen it happen time and time again. So same thing with writing off your G-Wagon.
The G-Wagon thing. You guys know how many reels have I made about G-Wagons? So, but I'm going to caveat what you just said because I have clients with RVs. I have multiple. We accountable plan them.
That's a totally different strategy. And yes, agreeing with that.
Partially. They're not business assets.
Don't depreciate it. Yeah. Right. Don't depreciate it on your return. Don't try to self-rent to yourself. Those are strategies that people try to do. So the idea is, you're the RV is owned by you personally. And so the business then, almost like the Augusta rule, right? The business rents the RV, pays you as a person. You then report it on your Schedule E because it's now rental passive. And now you get to depreciate the RV. No, it's been done time and time again. And every time it's been wrong. So absolutely, if you have a legal approach to it, like you mentioned, where you have a portion of expenses done through an accountable plan, that's absolutely available.
And for those listening who are like, okay, they're nerding out. And what is going on? No. So here's the thing. This is actually why there is not like one way to do anything. So you say, how can I deduct my RV? If you guys ask me questions in the DMs, it happens all the time, comments, DMs, everything. You say, how can I deduct this? I'm like, well, there's like 8 different ways. Just how legal do you want to be? Right. So like, what's the right way? A lot of the time I spend when I'm working with you guys as clients, a lot of the time you say, can I deduct this? And I'm like, hold please. And I go into my cave and I do research. Why? Because I know ways you could, but I don't know. I'm trying to think of the best way, the way that's going to be the least risky, the way that's going to be the optimal result with the lowest risk of any backlash and the easiest to support. So I think it was my mentor who said, you can deduct anything you want. It's just a matter of like, how good do you look good in orange? You know, it's, you can deduct anything you want. You can deduct anything you want on your tax return, guys. It's just a question of how by the book you want to be, how much you want to roll the dice, how risk tolerant you are. And just to kind of put a bow on this too, Jessica, one of my biggest pieces of advice is find a pro that matches your risk tolerance. Would you agree?
Yes. Oh, absolutely. Because I have seen specifically with working on like the criminal side of things where tax preparers were smooth enough in how they would present the information to their client to make the client feel secure in taking an absolutely aggressive or illegal tax position, with their idea of, oh, well, we've done this for hundreds of other people, which is great. But if it's illegal, it's illegal. It doesn't matter how many people have gotten away with it because, for every 100 people, there could be one person that gets caught, and then that one person gets caught and they're financially ruined because when you get an audit, you not only have to pay back the cost of the tax, you will, in many cases, get inaccuracy penalty. And if the understatement of tax meets certain thresholds, you then also get a fraud penalty. And these can be upwards of 75% of the tax that you now owe. So if you owe $100,000 and you meet some of these other metrics, you now owe $175,000 plus interest.
Oof. Yeah. You don't want to be in this position. I'm not we say we play in the gray. My approach, I say it's a measured risk approach. Do we always take the most like black and white? Like there's a balance between, well, what's the risk of this being disallowed? What is the favorable position for the client? And if it's super unclear, we're actually told as practitioners, when it's really that vague, that we're able to take the favorable position for the client if there's absolutely nothing that would support the other position. And that happens all the time because the Congress isn't the greatest at writing. So sometimes it's unclear. But I've absolutely loved this conversation, Jessica. We could talk for hours, and we have before. But I just want to say thank you for shedding the light on all of these different topics, from what you owe in taxes to audits. It's really, really helpful to speak from that perspective and to hear from someone who's been there and done that. Your resolution experience is extraordinary. So if you're a tax pro listening, make sure you're following Jessica on social media and looking out for her programs. And if you're just listening, make sure you're following her on Instagram. She's got some great knowledge to share, supplement what you're listening to here. And if you follow me with some of hers too, we got some great tax pros on the gram that I love supporting. So
on the gram, I love it.
On the gram. Thanks, Jessica, for being on again. I really appreciate it.
Thank you for having me.